Mr. Milind Karmarkar, Director and Fund Manager with Dalal and Brocha Portfolio Management Scheme. Over the years I've interacted with him, I've learned the art of patience, how to look at the big picture, let the power of compounding do its magic. Stocks, when you buy them, they may look overpriced, but if earnings and growth is there and if you're able to predict them, the magic will actually happen. So nice to have you back. I know, sir, you've been slightly under weather. So good to see you back and good to see your trademark smile back.
Thank you. Thank you. Good to see you too.
I hope you're feeling better now.
Yes, definitely.
Well, markets, if you've invested in the market, everybody's feeling wonderful.
Yeah.
What's going on? Why is that nobody's talking about Fed, problems in China, energy crisis in Europe? They are real problems.
I agree they are real problems. So global economy could be under pressure for some time. But if I look at India, I see this as a bright spot. And I do see India growing at anywhere between 6.5% to 8% for next 4-5 years. And like the protagonist in, which is that book? Protagonist in Reminiscence of a Stock Market Operator says that in the stock market, what has happened today has happened previously as well. And there is nothing new. So I 100% agree with that. So it's only a question of whether you have read your history properly. And if that is so, then of course you will be bullish at the current time.
Well, there's one more quote which I've read that courses remain the same but horses change. What has happened in the past has happened to different set of stocks, but this time around, even though the big picture is going to be on expected lines, what you said, the name of stocks and the outperformers will change because that's what they call as market cycles and mean reversion.
So absolutely, I agree with you. Like last time, between 2003 to 2008, we had a very strong rally in the markets driven by GDP growth, and the markets went up nearly 5.5, 6 times. And the key growth drivers to that were all the power and power ancillary stocks. This time they could be different because, but power and power ancillary stocks will also grow, but not to the extent which they went up last time, which was anywhere between 25 times to even 100 times. So, but yes, the basic fundamentals of GDP growth are in place. So we will see our per capita income going up significantly, and that will drive the markets, the consumption stocks, and many others.
There are two interesting aspects in this market. One is good business trading at high P multiple, they are doing very well. Whether it is a Vedant or a Trent, or some would say even some of the recent listings like Action Shoes or good old Asian Paints. But in this year, good old energy, value, high dividend yield stocks, power companies, they've made a comeback.
Yeah. So basically, in a situation where there is a strong GDP growth, as I said, that per capita income goes up, and it is more likely that the growth stocks will do better than the value stocks, and that is what I think will happen going forward. So if you see a company or a sector where you can have a 25-30% growth for next say 7-8 years, then I think that would be the sector to be in rather than being in pure value.
So you are of the view that one is better off looking at your understanding of the economy and where you see value migration happening. One is better off buying growth stocks rather than buying coal, cement, power and metal stocks.
Yes, I agree with that. So I believe that it will be growth stocks which will outperform the value stocks as well as the markets.
You always believed in this Charlie Munger theory of invert and be prepared. You always maintain some cash in your portfolio irrespective of good market or bad market.
Yes,
markets are at a new high, almost at a new high. What's been your portfolio strategy of late? Are you sitting on cash?
Portfolios, we are sitting on a little bit of cash, not significant cash, and we have added in the last few months a few industrials, because I do think that industrials will perform very well going forward, because we are seeing the capex cycle turn. So while talking to companies, we realize that capex has started almost across all sectors. So to take the benefit of that, we are invested in some of the industrial stocks. Besides that, consumption remains and continues to remain the main theme.
What were your top three holdings before COVID, and have your top three holdings changed now that COVID is over?
So as I said, that industrials have been added, but otherwise, most of the consumption-driven stocks we have been adding.
Question, sir, is that you've added industrial stocks, but
Yeah.
your top 3 or 5 holdings, let's say Jan 2020, and if I look at September 2022, have the top 3 or 4 names out of the top 5 names which you have, how many of them have changed and why?
Top three names are remaining same.
So
Because I do believe
COVID has
that-
come and gone and you've not changed your top 3 holdings. The world has changed.
No, I know, but these are the kind of stocks which can give me a 30-35% return year on year, or 30-35% growth year on year for next 10 years. So that is why I'm holding them.
I'm going to put this graph out of HUL, and the term which we want to use here is that who says elephants cannot dance. What has arguably been one of the toughest decade for the FMCG sector,
Yeah.
HUL market cap has become 3x and the margins have become 10%. The margins have gone up by 10%. How do you look at consumer staples? Because the consensus view, Mr. Karmarkar, is that these are good companies but bad investments.
So let me put it this way, that I do agree that FMCG stocks will continue to deliver, but not the kind of growth which I'm seeing in other stocks like retailing. So they will grow. They will grow at about 10-12%, or they can grow at best at what the nominal GDP growth is, which is 13-14%. So they will be market performers. In certain cases, they will be outperformers also, for simple reason that they are good solid stocks which can continue to grow. So it's a good place to hide. So that's what I think people will do. But otherwise, my bets would still be on other stocks.
If I may take the liberty of asking you that what were your top 3 or 4 holdings before COVID and what are they right now?
So, well, they continue to be Trent, they continue to be Titan. So these are the kind of stocks which I will continue to hold.
Okay, I'm going to put another chart of Titan here. And this, again, I must share with our viewers that Mr. Karmarkar also has been holding on to Titan for almost 20 years now. And that is one of the biggest wealth creator for his clients and for his investors. Now, the chart of Titan, this for the benefit of our viewers, Mr. Karmarkar, what will come up on the screen is that Titan, which is the most rewarding stock for you and for Rakesh Jhunjhunwala, has seen corrections, and it has seen a 60% fall in 2008, it has seen a 30% fall in 2016, and it saw a 40% fall in 2020. But during your 20-year holding period, Mr. Karmarkar, you've not sold the stock, or wherever you've sold, you only booked tactical profits. As a business, you were never bearish on it.
Yeah, I agree. And even now I'm extremely bullish because it still constitutes a very small percentage of the overall market share. So the opportunity is very large there. And they're doing all the right things. They have been growing, they have been adding stores. So I believe that, these type of stocks, you make more money by just holding rather than trying to sell book profits and buy it at a lower price, because most of the time you will probably miss the rally after the stock falls.
When you keep a portfolio which is not changing, you hardly buy 1 or 2 stocks in a year, maybe 20 stocks in a decade, I'm sure your clients must be telling you, we give you a fee for identifying new ideas, not to sticking on to the whole ideas.
No, so it's like this, that I prefer to tell clients what I'm going to do. And if the client is happy with that, then only the client is onboarded. Because we are very clear that it's not the action what we will be focusing on, but we will be focusing on giving the client a reasonable return over a longer period of time. So there is a possibility that sometimes we may underperform, but over a longer period of time, the stocks like the growth stocks definitely give the kind of return which could be market out.
Have you dipped your toes in any of the fintech or the niche consumer fintech companies?
So we are not so far invested in fintech companies, but we are trying to play it uh, through the banks, because I think that, and of course, there are certain large finance stock which are using fintech apps and other things to grow. So we are rather preferring those rather than focusing on the small stocks, because there are a lot of issues regarding RBI regulations and things like that. So once those things are settled down, then we may look at fintech.
Is not making cash flows or is burning cash and is not PAT accretive, will you give it a complete skip, which means irrespective of what the big picture promise for a Zomato or a Policy Bazaar or Paytm is, because it's not making cash and may not make profits for next 2-3 years, it's a no, 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 no?
So it's like this, that I would like to bet on stocks where there is a solid backing. So the balance sheet, either of the company is good or the group backing it is very good, and it's into a niche segment. I'm willing to take a bet that because of the support which it gets from the group, uh, the company can do well over a longer period of time. It gets the management advantage, it gets the financial muscles, and of course, it gets the other group company benefits as well. So, because I have seen this happen in, let's say, my top performing stocks in the last 20 years, which were Voltas, Titan, and Trent. So, all of them, Trent was a stock which was at 60 rupees, 10 rupee paid up in 2002. And they just had cash in the balance sheet. They just started they had two stores when I started looking at it. And the market was not willing to accept that this can be a large, retailing can be a large business. Same thing is true with Voltas also, again backed by Tata's. And Voltas had declared losses in 2002-3, but they were changing course. They were focusing more on the engineering contracting business, and of course, they had the unitary cooling business. And third was Titan, again a watches company, but getting into jewelry, which I thought was a large opportunity, again backed by Tata. So what I have seen is that any business which is backed by a strong balance sheet in a new area is likely to do very well over a longer period of time. So I would rather bet on these type of companies rather than betting on the new sort of fresh companies. Of course, it's not that we don't look at fresh companies. We do look at fresh companies, but there has to be some certainty on cash flows over a longer period.
Okay, in markets, wealth is created not by looking at the rear view mirror. You have to look at the windshield.
That's
What we've
correct.
done so far, sir, is looked at perhaps the rear view mirror. Why Titan worked for you, how did you invest in Trent, and how Voltas has been exceptionally strong for you. Let's look at the front view mirror. What is the front
Sorry.
view mirror telling you? What is the
So
windshield telling you?
front view mirror is telling me that India will grow at as I said, at a rate of about 6.5 to 8%. Add to that a 4-5% inflation, so 13% growth for the next 5-6 years is probably given, and this would lead to India reaching the $5 trillion economy, and in all probability, the per capita income also more than doubling in next 5 years. And if that happens, then of course, what can drive consumption is phenomenal. But again, when I say consumption, I include hospitals, I include pharmaceuticals, I include insurance companies, and I also include banks and NBFCs. So it's a slightly wider range of consumption, because all of them benefit when the per capita income goes up. So that's where my focus will be, apart from the industrials which I talked.
You won't do insurance companies in the past, something which we've discussed. One life insurance, one general insurance. Given that
That's
LIC
correct.
has got listed now, there are new entrants in the health insurance sector. Have you revisited your insurance stocks? I think it was HDFC and ICICI Lombard, if my memory
You're
serves me
correct.
right.
You're correct. And both of them have been an underperformer. About that,
Does that
I
bother
do
you?
agree.
Does that bother you?
No, it doesn't, because I do see a long-term potential of growing at 18 to 20% in most of the insurance companies over a longer period of time. So as long as these companies can deliver a growth rate which is, say, 30-40% higher than the GDP growth, I think the stock price will start delivering. May not be in 6 months, maybe 2 years, 3 years, but they will start delivering.
The challenge with ICICI Lombard is that they are still living off the float, if I may use the word. They're still not a profitable franchise. And other health insurance companies are profitable. Does that change the argument for the business in terms of a viability?
So no, it doesn't change the my thought process behind that, because I do see ICICI Lombard as a big opportunity. Rather, why ICICI Lombard? All the general insurance companies, there is enough space for all of them to grow. It's not one company, one particular company. So all these companies in insurance space can grow very fast and very well. So especially after the pandemic, I do expect the health insurance business to pick up. In the pandemic, there were issues on passenger vehicle also. Now passenger vehicle sales has also started. So four-wheeler and two-wheeler insurance is also likely to do well. And because of that, the entire general insurance sector is likely to do well.
What are your thoughts on defense, railways, manufacturing, Atmanirbhar theme? You know, one aspect which long-term investors like you look at is the size of the opportunity. Consumption is the size of the opportunity which is making you excited. But let's say if defense opens up or railway capex starts, aren't these big profit pools which will get created where you should participate as an investor?
So railways can be a big opportunity, but as of now, I'm not finding any company which can deliver that kind of a growth. Uh, Pharma again is a great, not pharma. Uh, PSU defense companies also is a big opportunity, but they are yet to deliver the numbers. So we are looking at defense companies as well. We'll probably buy them at the right time, because Make in India makes a lot of difference. So manufacturing, as I said, we already have positions, but when it comes to defense, we are looking at these companies, and we will probably buy a couple of them in the near future. Once we are convinced that the growth is sustainable over a longer period of time.
15-20 year chart of Trent, and the reason why I'm putting this 15-year 20-year chart of Trent is because A, Mr. Karmarkar I think has invested in this from 2000, B is holding on, and for longest time I have remembered Trent was never a stock which became a value stock. It was always a stock which was trading at P multiples which were higher, which were greater, and which were above average in terms of the market benchmark. When you invested into Trent, and I'm not getting into once upon a time, there you go, what a lovely looking graphic here, and only capturing what, 10 years. If I capture 20 years, the percentage gains here would be phenomenal. Mr. Karmarkar, when you invested into Trent, they had sold off Lakme. After that, they moved into grocery. Now there is a Zara interplay which is coming up.
Yeah.
Did you anticipate this kind of an foresight from the management, or it is just that you betted on the right guy, right business, and it just turned?
So when I looked at Trent, I was looking at all the retailing companies. So in fact, Trent and Titan came in because of that. Because what I realized was that in the US, from I think early 60s to early 80s, the largest growth was in retailing companies. And so whether it was Walmart or many others. So that is the reason why I started looking at retail in India, because I did believe that over a longer period of time, people will have an habit of going and shopping for, let's say, for a week or for a month. So going once a month or once a week to the mall and hypermarket and buying their requirements. Now the thing was that at that point in time, no one was willing to believe that, and everyone thought that in India, where you have a neighborhood grocer, this will not happen. Even now, people are worried that online businesses like Big Basket or many others can disrupt the kind of growth which these companies are showing. But my view there is slightly different. See, if you go to US, you still see most of the people going and buying things from Walmart because you can have a look and feel, and then buy it. Uh, so people do go on weekends to Walmart and other such hypermarkets and do buy things uh, in a physical store. So I think that will continue to happen in India as well. And that's what my view was earlier. Coming back to what I thought or what my interactions with the management that time were. So that time the management believed. So when I asked them how large you can become, so they said that Milind, we can become about 90 stores in 10-15 years. So that was also a big growth because from 2 to 90 is 45 times. Not only they delivered that, but now they are adding about more than 100 stores, which includes, of course, Zudio. But it is more than 100 stores every year. And even now, the kind of growth which can come in these stores is phenomenal. And that is the reason why I continued to buy in the portfolio over a longer period of time, as and when we got an opportunity. And we will continue to do so in all the retail.
Now, with that acknowledgement that you invested into Trent and you've shared this very wonderful insight with us, which are the industrial stocks you've invested in? Where have you been shopping?
I can't tell you what industrial stocks I'm invested in, but they are typically stocks where we are looking at decent growth in the coming years, and we have already seen growth coming into them in the last 2-3 quarters. So that is the reason. I can't disclose them, obviously, but we have been buying into these stocks for some time now, and will continue to do that.
Wrap it up with one comment on HDFC Bank.
But they are not the routine names, let me put it that way.
Okay. You're dropping hints. Our viewers can catch the hint, perhaps. I'm going to wrap it up with one big merger which is approved and which is due in the banking sector. HDFC Bank and HDFC Limited.
Correct.
Two behemoths coming together. A different side of balance sheet gets created. What would be the implications of this for HDFC Bank shareholders and for the home mortgage market?
So I think ultimately both will benefit because of the sheer size. HDFC will, so as a consolidated entity, it is possible that HDFC, that is the home finance business, will start getting funds at a cheaper rate. And that will be a new growth engine for the HDFC Bank. So I continue to be bullish on this merger because though some people say it will create a large entity, but that is at $2,000 per capita. You have $5,000 per capita, then the opportunity continues to be extremely large.
So nice to have you back. Wish you a speedy recovery. And so nice to see that trademark smile of Mr. Milind Karmarkar back.
Thank you.